Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Now, this was a new year that did not begin very well for global markets in general and India in particular. Trading in the Chinese stock markets were halted on January 4th, Monday, and again on Thursday after markets crashed by 7% on each occasion. The Chinese sell-off sent shockwaves throughout the global markets, including India. Significantly, China has allowed the value of its currency, the yuan, to depreciate, triggering fears of waves of competitive devaluation in the region. Back home, this once again raises concerns in the immediate and the longer term impact on India's economy and its vulnerability to external factors, particularly since the domestic market is not as strong as it's hoped. Let's discuss this a little further with our guests today, Debopam Chaudhuri, Chief Economist, ZyFin, and Sujan, Hajra, Chief Economist, Anand, Rathi. Gentlemen, thank you very much for joining us. Let me begin with you, Sujan. So why is this happening? This came out of the blue.
Yeah, I think it's more of a technical in a sense because the circuit breakers are put to use and obviously that had set off some kind of thing. What you have to understand is that the Chinese equity market, particularly in the mainland, is very, very different from what it is in the advanced countries or even India.
Okay.
So they are moving there, they are trying to fine tune their system. So therefore, today the circuit breakers have been removed, market has been volatile. But market is actually doing pretty well. So I think it's more of a fear factor of introduction of the circuit breakers, apart from the fact that obviously the Chinese economy is not doing very well, the numbers are not looking good.
But has something fundamentally changed in our perception of the Chinese economy or the reality that is the Chinese economy?
No, see, for example, there is a large amount of skepticism about Chinese data, particularly Chinese macro data. So, particularly, you don't know what the slowdown has been in the economy. You don't know what are the bad assets in the banking system. So, those kind of apprehensions are there.
Right.
But as you said, there has nothing which has changed fundamentally over the last 1 week to call for this. So I would rather think it's more of a technical in nature in terms of the stock market circuit breakers.
Right. Okay. So Debopam, is this once again exposing our vulnerability?
Yes. So definitely a bad way to start the year. So there's this rising chatter which is linking the current situation with what we saw in 2008 after the subprime crisis broke out. So that time it happened from US, now it's happening from China. Is what the chatter is. But I would like to go a little more behind in time, and I would like to connect this to what happened during the Great Depression of 1929 when Dr. Keynes came up with his theories. So what happened during then was this serious or severe currency war which was waged between exporting nations in order to make their goods cheaper to countries who are buying their stuff. So China, according to me, is exactly doing that. It is gradually making its currency, its goods cheaper by devaluing its currency. This is the second round of devaluation which we saw in the last 6 months. So definitely a currency war is waging, and I would like to also get back to what Dr. Raghuram Rajan said sometime around, I think, June last year in a session in London, where he in fact specifically mentioned that this is a type of thing, this kind of a currency war is about to be waged until and unless all the monetary policy makers at least come on the same page, get a common platform to talk and decide how to get the world economy out of this mess, because the world economy has been suffering a slowdown for the last 2-3 years now.
Right. So this currency war is also likely to trigger competitive devaluation, i.e. if China is allowing its currency to slide down, so should we. That
is what happened during Great Depression. So if you have to go by experience, that is what not just India but every other exporting emerging nation is expecting to do or expected to do. So, but then the more important thing, or the more strange, or the more thing to be cautious about is Indian currency has weakened substantially over the last 1 year or 2 years. Even then, if you look at the trade deficit between India and China, the trade deficit between India and China is almost more than double the overall national trade deficit India has. So despite India's currency weakening, the cake is being taken away by China by making its exports, making its goods much more favorable in international economies as well as in India.
Right. Okay. So is this the biggest concern that we are now faced with? I mean, from an overall economy standpoint, we'll come to the domestic in a bit.
Sure. No, China is obviously the biggest risk factor.
And the currency.
On currency, I have a slightly different opinion.
Okay.
My sense is that if you look at between 2008 to 2014, Chinese currency every year was appreciating at a 8% against rupee. So Chinese currency is more than 50% overvalued if you go back from 2008 level. So I don't think it's currency which really explains the increase in India's imports from China. or the increasing Indian trade deficit. What I think is that what we are importing from China, most of these products are not produced in India. For example, if you look at
phones,
very large part of the consumer durables, whether it's mobile phones, whether it's TV, flat panel, most of the things are assembled in India rather than produced in India. So you don't produce those things. So Make in India, that campaign is extremely important for India. Otherwise, just by devaluing your currency, you won't be able to compete with China.
Right. Okay. So we have a problem with our own economy, which is that it's not growing as we thought it should or would, and we are also faced with these external shocks that are coming in and out of the blue, evidently. So what should we be now focused on as a country?
See, what China is trying to do, according to me, is it's gradually shifting its focus from being an export-led economy to being a more internal consumer-based economy. We already are a consumer-based economy. So if consumer-based economy is the way to go for emerging nations, then we should further, strengthen this consumer base of ours, this consumer spending or aggregate demand within the economy. Today, the problem in China, or the problem that is connecting India and China, is in a very simple, if you look at commodity prices or metal prices are going under the ground, right? They're steeply declining. One big reason is China is a very big importer of raw metal and a very big exporter of finished steel and other such products. And India is a very big exporter of raw metal. So Chinese markets are not able to consume that finished product.
Yeah, so their own consumption is declining because they're producing less.
Exactly.
Yeah, right.
So Indian government needs to focus more on boosting the aggregate demand as well as the consumer expenditure in some way, which will definitely help us in boosting our GDP, because 60% of our GDP is consumer spending.
Right. So would you agree with that, Sujan? That, I mean, while the external shocks will come as they are, I mean, this in some ways puts the spotlight back on how we manage our own economy, and within that it really boils down to demand.
No, I would actually say to the contrary.
Okay.
Because this is exactly you did between 2007 to 2013. You tried to boost consumer demand without creating capacity. And particularly if you see
when you say capacity,
particularly in the food sector, agricultural sector, the kind of food inflation which you saw during this period. So I would rather say India has always grown strongly with investment. Now, clearly, you cannot boost investment in the manufacturing sector right now. So, there is a twofold strategy. First, you have to focus on infrastructure, and you have a huge amount of demand for infrastructure capacity. So, the first step should be to boost infra investment, and eventually, as the capacity utilization in the manufacturing sector normalizes, then perhaps the 4 quarters, 6 quarters down the line, you should try to push manufacturing.
Right. So, but that's almost medium to long term, or actually it's more long term.
No, I'm telling even immediately, the immediate focus should be to increase your infrastructure investment.
Okay.
And that also has a multiplier.
So that we are committed to, as in whether it's railways or
But if you see at the ground level, with the exception of roads, this hasn't actually got implemented. If you see the spending of the railways, it hasn't happened. In electricity transmission.
So you're saying that the whole problem that we're facing on the external side, whether it's the China factor or global markets, all of this or even falling commodity prices, all of this can be countered only if we step up investment consumption or investment demand.
Investment demand is the biggest thing. See, the fact of the matter is ultimately economic like India, the external things matter at the margin. Given the kind of, we are most big economies, with the exception of China, are basically closed economy. If you look at US, if you look at Japan, if you look at India, we are closed economy. So your domestic factors play a much bigger role than the external factors. And something which is going wrong, it's more domestic than international.
Okay. Would you concur, Debopam?
Yes, absolutely agree to what Sujan is saying. And see, when I said consumption, I mean, people consuming more of international goods is not going to help the Indian GDP. So if Indian GDP has to be boosted through consumption, it has to be consumption of Indian made goods, the Make in India thing. And in order to make in India successful, definitely we need a huge infrastructural push.
Right. Okay. So let me circle back to the point that you made earlier on currency wars, because that's sort of a lingering kind of question. Where does that sort of head from here on?
Well, if these governors or these monetary policy authorities see the risk in it and they eventually get back from getting into a currency war, then definitely it will be a good thing for the world economy as such, or the emerging cluster as such. But if Brazil tomorrow gets into this bandwagon, or South Africa does it, and then eventually Raghuram Rajan is also supposed to do it, then definitely a further weakening of the entire emerging market currency basket is something that we can witness, and that will push the world economic growth to a further downslide.
Okay. If I were to now add this currency factor with the fact that commodity prices, including oil, are crashing through the floor, as it were? How do we view it then?
See, India and China, in fact, are the biggest importers of crude oil. And in both these economies, the business cycles are slowing down after some initial spurts in the cycle. So until and unless these two economies start showing some good amount of potential, I don't see a rise in crude oil demand and hence a rise in crude oil prices.
Okay.
So these two economies need to recover first.
Okay. Last word, Sujan.
Commodity price. What I think is that the commodity price after the super cycle is going to remain.
And will that help us? I mean, I know we
India,
keep
India
asking
is
this question again and
India
again.
is one of the rarest emerging market which is not a commodity economy. Rather, we are net commodity importers. So obviously, India gets benefited. But in the currency perspective, what you also should look at, it's really the commodity countries where the currency is depreciating very sharply, whether it's Brazil, whether it's Russia, to a certain extent Indonesia. So from that perspective, it's by economic logic, it's expected those currencies will depreciate.
Okay.
At the end of the day, a stronger dollar is also impacting US. So going forward, I personally don't think China has a plan of devaluing its currency in a big way. It's contradictory. If you are telling that China is moving from an export-oriented model to domestic economic model, then devaluing its currency, that doesn't make sense.
Right. And let's use this opportunity to bring attention and spotlight back on the Indian economy, as we've been saying in the past as well. We run out of time. We need to take a break, but we'll come back on the other side. We look at the impact of all of this on the markets. Stay with us. You're with Policy Watch. Welcome back to Policy Watch. Indian markets have taken heavy fire from the fall in Chinese and world markets, losing almost all the gains made in the last year. The BSE Sensex hit an 18-month low of 24,829 points before closing at 24,851 on Thursday before recovering on Friday. Commodity markets too continue to fall, with oil leading the pack, now trading at an 11-year low below $35 a barrel. With all-round falls in asset prices, what does this volatility mean for Indian markets in the near and medium term? Can domestic policy and action counter some of these global shocks? To discuss this, I'm joined by Ajay Bagga, Executive Chairman at OPC Asset Solutions, and G. Chokkalingam, Founder at Economics Research. Thank you very much both for joining us. Ajay, let me begin with you. This is obviously not a good way to start a new year. But having said that, the deeper question in some ways is, why did this come out of the blue?
Yeah, it really came out of the blue, and Chinese have to digest that they are the second biggest economy in the world. It's a huge market. They reached $10 trillion market cap last year. They're down to about $5.5 trillion. But bringing in a circuit breaker without doing proper testing and closing down their markets 2 days out of 4, I think they really roiled the markets. And second is, Govind, what started from August last year, the surreptitious devaluation in the Chinese currency that they have been trying to engineer. So that has really spoiled the market mood, because you don't know. Chinese regulations tend to be very opaque. You don't know what are their real motives. They hide it behind. Unlike, you see the transparency of Janet Yellen. She was shouting from the rooftops for 6 months, I'm going to raise rates, I'm going to raise rates. These are the criteria. She made sure it was a soft landing. Chinese, what you're really afraid is, where is the economy? But that you can still digest. It's okay, even if it's off by a little bit. But second, what is their view on the currency? If they start devaluing, they export deflation to the rest of the world. They start a currency war, which is right now an undeclared currency war around the world. It becomes a vicious circle, because then Malaysia has to devalue, Indonesia, Vietnam, Bangladesh.
Right. Yeah, and one of the guests in the earlier segment was saying precisely this, but we're almost going back to 1929 when we had currency wars between nations.
Yeah, and if trade plummets, so look at the Baltic freight index, it's really showing that the trade is plummeting, exports are down. That's the biggest issue for China.
Right. Okay, Chokka, so if you were to look at the pluses and minuses, domestic economy, global economy, and the markets, the way they reflected, how would you stack them up?
See, we are better positioned. All the global factors are bottoming out. It is reflected in IIP, excise duty collections, margin expansion, FDI inflows. Even the banking credit growth has become double digit after a gap of 6 months. Now, there is a concern on global deflation, but the Chinese market is not a concern for India at all. I will give you 3 specific reasons. In 2015, when India was down by 5%, the 3 best performing markets were Europe, Japan, China.
Okay.
And all of us know these are the 3 areas where the growth slowdown is the cause. And second, the trading in China has dried up. According to some estimate, the volumes have come down by 99% after so many restrictions. And after the shrinkage of volume, China has imposed a 7% circuit filter. We know from Indian market experience, if you have a circuit filter...
That's the wrong thing to do.
Yeah, wrong thing to do. 2%, the journey is very long. Third, even the fear on the currency is, huge, unnecessarily exaggerated. You would be surprised to know, yesterday the yuan hit 5-year low since 2011 March. But if you see the movement of rupee versus yuan has depreciated by 1% since March 2011, whereas Indian rupee has crashed by 33%. So all these things were overdone. That and fear psychosis is gripping. That is why yesterday, when Chinese fund managers sold for $45 million worth of equity, that became a global media news.
Right. No, let me put it the other way around. So why should Indian markets react in the way they are?
Excellent.
I mean, it's not about a particular day, but in general, we thought we were entering a new year of relative calm, but clearly we're not. But it's actually sort of extended volatility.
Excellent question. That is because the corporate earnings for large companies are not growing.
Okay.
So it is like a guy who has got a fear psychosis, whatever he sees, he will interpret as a ghost. So we got scared of bigger election. Then we were scared of, Fed hiking the rate. Then the markets were worried that the Fed was not hiking. Then finally hiking came. So all this has led to the crisis because there is no visible growth in the large cap companies' earnings.
Okay.
So my view, that has bottomed out. Going forward, next 2 quarters, we will see gradual improvement.
Okay.
That should help the market to withstand any further crisis coming from China or possibly even from Japan.
Right. Okay. So Ajay, if you were to now look at it over a 24-month perspective, I'm talking about markets and the way they've reacted to various news events, both international and domestic. How would you try and look ahead if you could on your crystal ball?
You have to shut out the noise first, because India is still a very domestic economy. It's a developed economy in the sense that the Indian consumer is a big chunk of our economy. China, only 40% of the GDP is accounted for by the Chinese consumer. India, it is as high as 65 to 70%.
Right.
It's more like Japan and US. So you have to shut out the global noise. Why you can't shut it out? Because you get inflows. Now, just to give you a small number, Govind, in 2008, at the peak of the crisis, emerging market funds lost $38 billion. Last year, they lost $73 billion. So that was the kind of correction in emerging market funds.
And when you say loss, this is because values have just gone down?
No, outflows.
Okay,
actual outflows, net outflows.
Okay.
India got 3 billion inflows. As a country. So we really outperformed. We should have been an A+ in the emerging markets, but when sell-offs happen, we are hurt on 2 things. One, other markets close down. Ours is a bigger market, you can sell more. Second, since you made a little money in India and they have been investing since 94, you try to book profits in India to offset losses elsewhere. These are the 2 big factors which link us into the global economy.
Right.
Good thing against this is 80 lakh SIPs have started. So that you're talking 40,000 crores on January 1st, which in the next 12 months will come in. Second, mutual fund inflows are coming. Now, if the government can get its act together, push the pension, push the insurance guys to do better. LIC comes in and gives stability. We need 10 more LICs in this market, if you ask me. We need to build a domestic bulwark against this international contagion that comes in.
So you're saying the bottom is reasonably stable, but we need to build on that.
Bottom is stable and we get sentimentally hit for inordinate reasons.
Okay.
We are not linked that much into the global economy. We don't get impacted.
But one of the factors affecting the bottom is the strength of corporate earnings, as you were saying, right? Could that change, and is that a key driver or likely to be a key driver?
It's going to take at least 2 quarters. Post Lehman crisis, at least your FMCG, IT, pharma helped. This time, you are seeing the series of alert from US hitting the pharma. IT companies are growing single digit. FMCG also growing volume in single digit. So that's a real pain. So therefore, I would be concerned more on the global deflationary pressures. If they continue, oil price crashes to $20 and number of countries reporting negative interest rate, negative inflation keeps rising, then there will be a major cause of worry. But if that hasn't happened, then India will be the best performing market in the world.
So that's corporate earnings. So what about non-corporate factors?
Non-corporate factors, I'm very comfortable. You look at the macro stability in terms of fiscal balance, current account balance, forex reserves, you have a lot of comfort. You look at, as I mentioned, IIP, excess duty collection, fuel consumption, the margin expansion. There are a lot of comforting factors. So what you need is little
So
push.
you said excise duty and fuel consumption. Those are linked, I'm assuming.
Yeah, they're all indicator of aggregate demand.
Yeah, okay.
Yeah, no, fuel consumption in terms of volume is quite robust,
Okay.
both the petrol and diesel.
Which is also pushing up excise duty collections. Yeah.
No, excise duty, even if you adjust for the duties, the excise duty collection, if you adjust for the duty hike on the fuel, still it is growing at 12-13%.
Okay.
So, which is quite rare.
Okay.
And also the plan expenditure is in line with the target. So, all this can push the large corporate earning from the middle of this current calendar
So
year.
Ajay, what should our policy responses be if we were to sort of create and build on this bottom that we've just talked about?
See, I think overly pessimistic analysis comes in on this government. If you see, I would give an A grade to the government, not an A plus. And why am I saying that? As Chokka was mentioning, you've controlled fiscal, you've controlled, hand of God has come in terms of oil. And what you were mentioning, Govind, your cost of oil is $14 at $33 a barrel. It comes to 14 rupees a litre if you just convert at 67. And you add about 6-7 rupees as refining and marketing transport. 21-22 rupees oil you're selling at 67. Brilliant, because it's coming in your pocket and it makes the renewables quite good to invest into. Otherwise you would not invest in if the government had got 70% of the fall in oil price from $115 to 33 you have kept in your pocket.
Right.
Brilliant. I think you got the best central banker going in Raghuram Rajan. You've done very good conservative work as a finance minister. What you have not done well is communicate it well, and second, manage the vested interests which will keep on making a lot of noise. I think those are the two things, and then structural reforms.
Okay.
You needed some big bang reforms, but in a messy democracy, it will not happen. So you should have managed it well and not staked your entire reputation on passing a land bill or a GST. I think that
Right.
should have been managed
So
better.
let me come back to that bottom question, because you're saying, both of you are saying that our bottom is still sound and therefore will not be exposed to further shocks, or even if there are further external shocks, we are unlikely to see too much bloodshed.
Even if we go down, we'll come up faster.
Okay, fair
And
enough.
who were the two biggest highest performing markets last year? Sorry to take half a minute more. Argentina gave 40% returns last year. Russia gave 25%. Both economies which are tanking. So there's very little correlation in the short term between economic performance, corporate earnings and the market.
Okay.
Ultimately it ends up. So
Okay.
we as fundamental guys will always say we need corporate earnings. But a lot of it is sentiment. And in India, we have to show the world that, this is a sweet spot. It is growing. It will grow for 20 years at 7% and still not have caught up.
Okay.
So you can get so much returns. There's rule of law, good corporate governance. You're getting a very staid and sophisticated regulator.
Right. Chokka, last word. Outlook for the next 3 months?
Next 3 months, I think only again the mid-cap stocks will do well. Index would be more or less within 3% plus in the range. But there is a bubble in the small cap. In 3 months to 6 months, I see a massive bust in the small cap bubble.
Okay. And you're saying that the larger caps, which is obviously based more on earnings, will recover only in about
By middle of the year.
economy looks
Middle
up.
of the year.
Well, gentlemen, we've run out of time completely. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.